Before we dive in, please remember that I am not a licensed insurance agent, a financial advisor, or an attorney. This video is for educational and informational purposes only. The world of insurance is complex and varies significantly by state and by individual policy. You should always consult with a qualified and licensed professional for advice tailored to your specific situation. Making insurance decisions based solely on this presentation could have serious financial consequences. Now let's get into it. Imagine this for a second. You're driving home from work. It's a Tuesday. You're thinking about what to make for dinner, listening to a podcast, just a completely normal day. You pull up to a green light, and as you enter the intersection, bam! A car blows through the red light from the other direction and T-bones your driver's side. The sound is deafening. The world spins. When things finally stop, you're dazed, your arm is throbbing, and your car is a twisted wreck. In the chaotic hours and days that follow, you're rushed to the hospital. You have a broken arm and severe whiplash. The bills start coming almost immediately. The ambulance ride alone is over $1,000. The emergency room visit, the x-rays, the doctor's fees. It's a mountain of debt piling up before you've even had a chance to process what happened. And to make it worse, you can't work. Your job requires you to be on your feet, and the doctor says you're out for at least 6 weeks. So not only are you facing tens of thousands in medical bills, but your income has just vanished. Now you're thinking, the other driver was clearly at fault. They ran a red light. Their insurance should pay for everything. And you're right, they should. But here's the terrifying reality of the American insurance system. Proving fault isn't instant. The other driver might lie. They might claim you were speeding or that their light was yellow. The insurance companies will launch their own investigations, which can take weeks, sometimes months. They'll argue, they'll negotiate, and they might even end up in a legal battle. And while all of that is happening, who pays for your medical bills right now? Who covers your rent and groceries when you have no paycheck coming in? This is the nightmare gap where millions of Americans find themselves financially ruined by an accident that wasn't even their fault. But what if there was a way to bypass that entire blame game? What if your own insurance policy could step in immediately, pay your medical bills, and even replace a portion of your lost wages, regardless of who was at fault? That is exactly why personal injury protection, or PIP, exists. And understanding this one single coverage could be the most important financial decision you ever make as a driver. In this video, we are going to pull back the curtain on PIP. We're going to demystify it completely. You will learn exactly what it is, why it's mandatory in over a dozen states, and how it acts as a powerful financial shield for you and your family. By the end of this, you won't just know the definition of PIP. You'll understand the fundamental philosophy behind it, and you'll be empowered to look at your own auto insurance policy with a new, much sharper eye. So, to really get why PIP is such a game changer, we first have to understand the system it was designed to fix. In the United States, there are fundamentally two types of car insurance systems: the at-fault system and the no-fault system. Let's start with the one most people are familiar with, the at-fault system, also known as a tort system. Think of this as the blame game system. In an at-fault state after an accident, the big question is, whose fault was it? If someone runs a stop sign and hits you, they are at fault. Therefore, their bodily injury liability coverage is responsible for paying your medical bills. Their property damage liability coverage pays to fix your car. It's simple in theory. The person who caused the mess cleans it up. But as we saw in our story, it's rarely that simple in practice. The at-fault system can be slow and contentious. It often requires you to prove the other person was negligent. This can involve police reports, witness statements, and lengthy investigations. If the other driver is uninsured or underinsured, you could be left trying to sue an individual who has no money, which is a long and often fruitless process. The entire system encourages finger-pointing and can lead to massive delays in getting the money you desperately need to recover. It also clogs up the court systems with personal injury lawsuits, which is a big reason a new idea was born. Enter the no-fault system. Around the 1970s, a number of states looked at this messy, lawsuit-heavy at-fault system and said, there has to be a better way. They created the no-fault system to achieve two main goals. First, to ensure that accident victims get paid for their medical expenses quickly, without having to wait for a fault determination. And second, to reduce the number of lawsuits clogging up the courts over smaller injuries. Think of the no-fault system as the stay-in-your-lane system. In a no-fault state, if you are injured in an accident, you turn to your own insurance company first to pay your medical bills, up to a certain limit. It doesn't matter if you caused the accident or if the other driver was 100% to blame. Your own policy pays for your injuries. The other driver turns to their own policy to pay for their injuries. You each stay in your own financial lane. This is a radical departure from the blame game. The question of fault for the injuries is taken off the table, at least initially. This allows for incredibly fast payment. You go to the doctor, you send the bill to your insurance company, and they pay it. No waiting, no fighting, no proving anything. And what is the engine that makes this entire no-fault system run? You guessed it, personal injury protection. PIP is the specific coverage on your policy that pays for these expenses. It is the heart and soul of the no-fault law. When a state passes a no-fault law, they are essentially mandating that all drivers carry PIP coverage to ensure that everyone has a source of immediate funds for their own medical care. So let's be crystal clear. PIP is first-party coverage. That means it's for you. It's for your passengers. It's for any family members living in your household who might be injured in an accident. It is your personal financial safety net. This is completely different from bodily injury liability coverage, which is third-party coverage. Bodily injury coverage pays for the people in the other car when you are at fault. PIP is for you regardless of fault. This is the most common point of confusion for drivers. They see they have bodily injury coverage and think, great, I'm covered for injuries. But you're not. That coverage is to protect your assets if you hurt someone else. It does absolutely nothing for your own hospital bills. PIP is the coverage that takes care of you. The genius of this system is its speed. Let's revisit our accident scenario. If you live in a no-fault state like Florida, Michigan, or New York, the aftermath looks completely different. Yes, the accident is still terrifying, but financially you're on solid ground. You go to the hospital. You give them your auto insurance information. The hospital sends the bills directly to your insurer, and your PIP coverage starts paying them immediately. When you realize you can't work, you file a claim for lost wages under your PIP coverage, and it replaces a percentage of your income while you recover. You're not calling the other driver's insurance company. You're not arguing with their adjuster. You're not waiting for a police report to be finalized. You are focused on one thing and one thing only, your physical recovery. The financial stress, which is often as debilitating as the injury itself, is massively reduced. That is the power and the promise of no-fault insurance, and it's all made possible by PIP. So what exactly is this magical coverage called PIP? The acronym stands for Personal Injury Protection, but I prefer to think of it as your financial first responder. It's the part of your own auto insurance policy that rides in the ambulance with you, metaphorically speaking, ready to pay for your immediate needs without waiting for the dust to settle, without waiting for police reports, and most importantly, without waiting to figure out who is at fault. It is a financial safety net, woven specifically for the chaos of a car crash. Let's break down what that safety net actually catches, because its scope is far broader and more powerful than most people realize. The first and most obvious thing PIP covers is your medical bills. This is the big one. We're talking about the ambulance ride, the emergency room visit, any surgeries you might need, x-rays, medication, follow-up appointments with specialists, and even things like dental work if your teeth were injured in the crash. It covers these expenses up to your policy limit. Immediately, you give your PIP information to the hospital, and the billing process starts through your own car insurance. There's no waiting for the other driver's insurance to begrudgingly accept liability. There's no back and forth. It's your coverage for your injuries right now. But this is where PIP starts to show its true value, moving beyond what you might expect. What happens if your doctor says you can't go back to work for 6 weeks because of a concussion and a broken leg? Your medical bills might be getting paid, but your rent or mortgage is still due. You still need to buy groceries. The electricity company doesn't pause your bill because you were in an accident. This is where the second major component of PIP kicks in: lost wages. Personal injury protection can reimburse you for a significant portion of the income you lose while you're unable to work and recovering from your injuries. This is absolutely massive. For so many Americans living paycheck to paycheck, an accident isn't just a medical crisis. It's an immediate financial catastrophe. Missing even a week of work can be devastating. PIP is the coverage that pays you to stay home and heal, instead of forcing you to choose between your physical recovery and your financial stability. It acknowledges the simple truth that healing is a full-time job, and it helps make sure you can afford to do it. And the support doesn't stop there. Let's say your 6 weeks of recovery are up. Your leg is out of the cast, but you can't just hop back into your old life. You need physical therapy to regain your strength and mobility. That's rehabilitation. PIP covers that too. It covers the cost of the physical therapists, the occupational therapists, and any other professional services you need to get back to the condition you were in before the crash. It's not just about patching you up in the emergency room. It's about seeing you through the entire recovery process. But what about the everyday tasks of life? This is where PIP becomes truly remarkable. It can cover what are called replacement services. Imagine you're a single parent who can't lift your toddler because of a back injury from the accident. PIP can help pay for childcare. What if you can't mow your lawn, clean your house, or even walk your dog because you're on crutches? PIP can help pay for someone to handle those essential tasks for you. Think of it as your substitute self. It covers the cost of hiring help to do the things you are now physically unable to do because of your injuries. This is a level of real-world, practical support that most other forms of insurance simply don't offer. It helps keep your life from completely falling apart while you focus on getting better. Finally, PIP deals with the most tragic of outcomes. In the event of a fatal accident, it provides a death benefit and can cover funeral expenses. It's a somber point, but it's a crucial part of the protection, offering a grieving family some financial relief during an unimaginable time. Now, a critical question I know many of you are thinking is, wait a minute, I have good health insurance. Why do I need PIP to cover my medical bills? This is one of the most common and important points of confusion, so let's clear it up. While your health insurance is fantastic, it wasn't designed for the specific scenario of a car accident, and it has some major gaps that PIP is designed to fill. First, think about your health insurance deductible and copays. Many people have high deductible plans today, meaning you might have to pay thousands of dollars out of your own pocket before your health insurance even begins to contribute. A single ambulance ride and your visit can easily eat up that entire deductible. With PIP, the deductibles are often much lower or even zero. It kicks in from the very first dollar, saving you from a massive upfront expense when you're most vulnerable. Second, your health insurance has networks. Your plan only fully covers you if you see in-network doctors and specialists. After a car accident, you don't always have the luxury of choice. The ambulance takes you to the nearest trauma center, and you see the surgeons and specialists who are on call, regardless of whether they're in your network or not. This can leave you with huge unexpected bills. PIP, on the other hand, generally doesn't have network restrictions for accident-related care. It pays for the reasonable and necessary medical treatment you need, period. And third, and this is the most important distinction, your health insurance does not, under any circumstances, pay for your lost wages. It does not pay for replacement services like childcare or house cleaning. It does not provide a funeral benefit. Your health insurance has a rulebook designed to cover sickness and routine medical care. PIP has a mission to make you as whole as possible, medically, financially, and functionally, after a car accident. It's a specialist, and your health insurance is a generalist. You need the specialist when you're dealing with the specific trauma of a crash. So we know what PIP covers. The next logical question is, who does it cover? The answer, again, is broader than you might think. Of course, it covers you, the policyholder, if you're injured while driving your car. But it also covers any passengers who were in your car with you at the time of the accident. Your kids in the back seat, your friend riding shotgun, your coworker you were carpooling with, they can all be covered by your PIP policy, regardless of who was at fault for the crash. This prevents horrifying situations where your injured friends or family would have to sue you or fight with another driver's insurance just to get their medical bills paid. And it goes even further. In many states, your PIP coverage follows you. If you're a pedestrian and you're struck by a car, your own PIP policy can kick in to cover your injuries. The same applies if you're out riding your bike and you're hit. It even covers you if you're a passenger in someone else's car. It is truly personal injury protection. So let's put it all together. Personal injury protection pays for your medical bills, your lost wages, your rehabilitation, and even essential services you can no longer perform. It does this for you, for your passengers, and often for you even when you're not in your car at all. It does all of this with little to no deductible, and it does it immediately, without ever asking that toxic, delay-inducing question. Whose fault was it? The blame game is paused. Your recovery is the only priority. Now, if this coverage is so comprehensive, so logical, so fundamentally helpful to people in one of the worst moments of their lives, it begs the question, why doesn't every single driver in the United States have it? Why isn't it standard everywhere? The answer is a complex patchwork of state laws, a philosophical divide in how we approach accidents, that has split the country into two very different camps. Understanding which side of that line your state falls on is one of the most critical pieces of information you can have as a driver. It can mean the difference between the streamlined recovery we've just described and the chaotic fault-finding nightmare we talked about earlier. And untangling that map state by state is exactly where we're going next. So let's pull up that map. If you look at the United States from an auto insurance perspective, it's not one country. It's a patchwork quilt of 50 different philosophies on how to handle the aftermath of a car crash. Some states decided the old way, the blame game, the long court battles, was broken. They wanted a system that prioritized healing over finger pointing. These are the no-fault states, and they form the heartland of PIP coverage. There are about a dozen states that mandate PIP coverage as part of a no-fault system. Think of them as the pioneers of this idea. Florida is a classic example. If you get into an accident in Miami, it doesn't matter if you were rear-ended at a stoplight or if you made a mistake and clipped someone else. For your initial medical expenses, you don't call the other driver's insurance company. You don't hire a lawyer to prove it wasn't your fault. You call your own insurance company. Your own PIP coverage kicks in immediately to pay for your doctor visits, your hospital bills, and even a portion of your lost wages, up to your policy limit. The question of who pays is answered instantly. Your policy pays. The question of who was at fault can be sorted out later, usually between the insurance companies themselves, for damages that go beyond what PIP covers, like major vehicle repair. The system is designed to get you medical care first and ask questions second. New York, New Jersey, Massachusetts, Hawaii, they all operate on a similar principle. Your own insurance is your first line of defense for your own injuries. But this is where the patchwork quilt starts to get really interesting because no two states do it exactly the same way. The rules, the coverage limits, and what you're allowed to sue the other driver for vary wildly. And then there's Michigan. For decades, Michigan was the ultimate embodiment of the no-fault ideal. It was the only state in the country that required drivers to carry unlimited, lifetime personal injury protection. Think about that. If you were catastrophically injured in a car accident in Michigan, your auto insurance would pay for your medical care for the rest of your life. It was a remarkable promise of security, a social safety net funded through car insurance. But it also led to some of the highest insurance premiums in the entire nation, creating a fierce debate that raged for years. In 2020, Michigan went through a massive reform, and drivers can now choose different levels of PIP coverage, including opting out entirely if they have other qualifying health insurance. Michigan's story is a powerful lesson. The promise of a perfect, immediate safety net comes with a very real cost, and finding the right balance is the central challenge every state faces. So you have this core group of states where PIP is not just an option, it's the law. It's the foundation of how the entire system works. But as we move away from that core, the picture gets a bit more complex. We enter the choice states. These states looked at the pure no-fault system and the traditional at-fault or tort system and decided to let the drivers choose. Pennsylvania is the perfect example. When you buy car insurance in Pennsylvania, you are faced with a critical decision. You must choose between full tort and limited tort. If you choose limited tort, you save money on your premiums, often a significant amount. In exchange, you agree to live by no-fault principles. Your own PIP will cover your medical bills, but you give up your right to sue the at-fault driver for pain and suffering unless your injuries are considered serious, a term with a specific legal definition. However, if you select full tort, you pay a higher premium, and in return, you retain your unrestricted right to sue the at-fault driver for any and all damages, including pain and suffering, no matter how minor the injury. You're essentially paying more to keep your legal options fully open. Kentucky and New Jersey have similar systems that give drivers a choice, forcing them to weigh the immediate savings on their premium against the potential value of their right to sue in the future. It's a fascinating compromise, putting a profound financial and legal decision directly into the hands of every single driver. Now let's zoom out even further on our map. We've seen the mandatory states and the choice states. The third and largest group are the add-on states. In these states like Texas, Oregon, or Maryland, the underlying system is the traditional at-fault or tort system. If someone runs a red light and hits you, their insurance is ultimately responsible for your injuries and damages. You are fully expected to file a claim against them, and if necessary, sue them to be made whole. So where does PIP fit in? Here, it's an optional coverage you can add to your own policy, and it acts as an incredible frontline defense. Think of it this way. In an at-fault state, getting the other driver's insurance to pay can take time. They need to investigate the accident, determine their driver was 100% at fault, review your medical bills. This can take weeks, even months. What do you do in the meantime? The hospital wants its money now. Your physical therapist needs to be paid now. This is where optional PIP is a lifesaver. While the two insurance companies are battling it out over who was at fault, your own PIP coverage can be paying your medical bills and covering your lost wages immediately. There's no waiting period, no deductible. It's your money for your recovery available right away. Then, once the at-fault driver's insurance finally pays up, your insurance company can get reimbursed from them. You've used your PIP as a bridge, a financial float to get you through the most difficult and uncertain time, right after an accident, without having to drain your savings account or go into debt. In these states, you'll often see PIP sold alongside another, similar-sounding coverage called medical payments coverage, or MedPay. They're easy to confuse, but there's a crucial difference. MedPay is simpler. It typically only covers necessary medical and funeral expenses. That's it. PIP is much broader. As we've discussed, it also covers lost wages if you can't work, and it can even pay for replacement services like hiring someone to help with childcare or housekeeping if your injuries prevent you from doing it yourself. PIP is a more comprehensive safety net. So we have this incredible diversity. You have the no-fault states where PIP is the star of the show. You have the choice states where you decide if you want to play by no-fault rules. And you have the add-on states, where PIP is a powerful supporting actor in a traditional at-fault drama. And of course, there are the remaining states that are pure tort states, where PIP isn't offered at all, and your only options are MedPay or relying on your personal health insurance. Knowing which type of state you live in is the absolute first step to understanding your own auto insurance policy. It dictates the fundamental rules of the road after a crash. It determines whose insurance you call first, what benefits you're entitled to immediately, and what your rights are when it comes to seeking compensation from another driver. But this map, this journey across the three zones of PIP, only answers the question of where and why. It doesn't answer the most practical and personal question of all. How much? When you look at your policy, you see numbers next to your PIP coverage. $10,000, $25,000, $50,000 or more. What do those numbers actually mean? How much is enough to protect you and your family without overpaying for coverage you don't need? Choosing the right limit is one of the most important financial decisions you can make as a driver, and getting it wrong can be devastating. And that decision, that critical number, is what we need to break down next. So let's talk about that number. Let's imagine two drivers. We'll call them Sarah and Ben. They live in the same city, drive similar cars, and work in the same hospital. Sarah is a nurse and Ben is a physical therapist. They both get their auto insurance from the same company, but they make one tiny, critically different choice. When Sarah is setting up her policy, she sees the option for personal injury protection. Her state requires a minimum of $10,000. She thinks, okay, the state says $10,000 is the minimum, so that must be enough. It's the cheapest option, and it saves her about $15 a month. She clicks the box and moves on. Ben, on the other hand, hesitates. He's a physical therapist. He sees people every single day who have been in car accidents. He knows that a minor injury on paper can turn into months of painful recovery and lost work. He sees the option for $10,000, but he also sees options for $50,000, $100,000, and even $250,000. He thinks about the cost of an ambulance, an emergency room visit, and the long road of rehab he guides his own patients through. He decides to pay the extra, maybe $25 a month, for the $100,000 limit. Feels like a lot, but he sees it as an investment in his own well-being. 6 months later, Sarah is driving home after a grueling 12-hour shift. She stopped at a red light, thinking about what to make for dinner. Suddenly, bam! A distracted driver slams into her from behind. It's not a high-speed crash. The cars aren't totaled. The airbags don't even go off. But her head whips back and forth violently. She feels dazed, confused. An ambulance is called as a precaution. At the hospital, the doctors check her out. They diagnose her with a concussion and severe whiplash. They run a CT scan to make sure there's no internal bleeding, give her some pain medication, and send her home with instructions to rest and follow up with a specialist. Now the bills start to arrive. And this is where Sarah's $15 a month savings starts to look like the most expensive decision of her life. The ambulance ride alone is $1,500. The emergency room visit with the doctor's fee, the nurses, the CT scan, and the medication comes to $6,000. Just like that, $7,500 of her $10,000 PIP coverage is gone. Wiped out. From one evening. But her problems are just beginning. Her neck is so stiff and painful she can barely turn her head. As a nurse, she can't do her job. She can't lift patients, she can't stand for hours on end. Her doctor tells her she needs to take at least 3 weeks off work to recover. Sarah's weekly take-home pay is about $1,200. 3 weeks off means $3,600 in lost wages. Her PIP policy is supposed to cover lost wages. But remember, she only has $2,500 of coverage left. That $2,500 is used up in the first 2 weeks of her being out of work. The last week? That's completely on her. $1,200 just gone. On top of that, her doctor prescribes physical therapy to help her regain motion in her neck. He recommends 3 sessions a week for the next 8 weeks. Each session costs $200. That's a total of $4,800 for the physical therapy she needs to properly heal and get back to her job. Let's do the math. Ambulance, $1,500, or $6,000. Lost wages, $3,600. Physical therapy, $4,800. The total cost of this minor accident is $15,900. Her PIP limit? $10,000. She is now personally on the hook for $5,900. And that's assuming there are no other complications, no other specialist visits, no further treatments. That money has to come from her savings, her credit cards, or from borrowing from family. The financial stress is immense, and it's actually slowing down her physical recovery. But wait, it actually gets worse. We haven't even talked about her deductible. Most PIP policies come with a deductible. It's the amount you have to pay out of your own pocket before the insurance company pays a dime. Let's say Sarah's deductible was $500. So, of that first ambulance bill, she has to pay the first $500 herself. Now her $10,000 limit is really only $9,500 of actual coverage. And then there's coinsurance. This is a detail buried in the fine print that destroys people financially. In many states, even after you pay your deductible, PIP doesn't cover 100% of your bills. It might cover 80%. That other 20%? That's on you. It's called coinsurance. So on Sarah's $6,000 ER bill, after her deductible is met, her insurance would pay 80%, or $4,800. She is responsible for the other 20%, $1,200, out of her own pocket. All of this is happening while her $10,000 limit is draining away. So not only is she capped at a low overall limit, but she's also bleeding money on every single bill along the way. The $10,000 safety net she thought she had is really a sieve, full of holes she never knew existed. Now let's rewind and look at Ben. Same accident, same injuries, same bills. Total cost, $15,900. But Ben chose the $100,000 limit. The ambulance bill comes. He pays his $500 deductible. His insurance covers the rest. The $6,000 bill arrives. He has to pay his 20% coinsurance, which is $1,200. But the crucial difference is this. He has an enormous well of coverage left to draw from. His physical therapy bills, all $4,800, are covered. His lost wages for all 3 weeks, $3,600, are covered. He doesn't have to choose between healing his body and paying his rent. He doesn't have to go into debt to get the treatment he needs. His total out-of-pocket cost is his deductible plus his coinsurance, which is a manageable amount. He can focus on getting better. The extra $25 a month he paid for his premium bought him $90,000 of extra peace of mind and financial security. It's the best investment he ever made. So when you're looking at that list of PIP limits, $10,000, $25,000, $50,000, $100,000, don't just see them as numbers on a screen. See them through the lens of Sarah and Ben's story. Don't ask, what is the minimum I'm required to have? Ask, what would be the true cost of an accident? Think about your own life. How good is your health insurance? What's the deductible? What's the out-of-pocket maximum? Some health insurance plans are great, but many have clauses that make them the secondary payer in a car accident, meaning they won't pay until your auto insurance, your PIP, is completely exhausted. How much is in your emergency fund? Could you write a check for $5,000 tomorrow without blinking? How much paid sick leave do you have at work? Do you have short-term disability insurance? If your income stopped for a month, what would happen? Who depends on that income? A spouse? Children? Choosing your PIP limit isn't just clicking a box. It's performing a risk assessment on your own life. It's a calculated decision about how much financial force field you want to put between your family and a single moment of bad luck on the road. The state minimum is a legal requirement, not a financial recommendation. It's designed to protect other people from you, not to protect you from reality. The reality is that modern medical care is astonishingly expensive. A single night in a hospital can cost more than the minimum PIP limit in many states. And the decision you make in 5 minutes on an insurance website can dictate the course of your life for the next 5 years. This is why understanding how your PIP coverage works with your personal health insurance is not just important. It's the absolute key to making an informed choice. The two policies are designed to interact, but that interaction can be complicated and sometimes downright adversarial. And figuring out that puzzle is the next essential step. Let's dive straight into that puzzle, because this is where a simple car accident can spiral into a financial nightmare. Imagine two giant insurance companies standing over your hospital bed, pointing fingers at each other, both saying, "You pay first." "No, you pay first." While they argue, the bills are piling up on your nightstand, and the hospital is asking for a credit card. This isn't a bad dream. It's a real scenario that plays out every single day across the country. And it all comes down to one crucial concept: determining who is the primary payer and who is the secondary payer. Think of it like a relay race. The primary payer is the first runner. They have the baton and they have to run their leg of the race first. They pay the medical bills right from the start up to the limit of the policy. Only when they've finished their leg, meaning they've paid out the maximum amount they're responsible for, can they pass the baton to the second runner, the secondary payer. The secondary payer then takes over and starts covering the remaining costs, according to their own policy terms. Simple enough, right? But here's the multi-billion-dollar question. In the race between your personal injury protection and your regular health insurance, who is the first runner? Who is legally obligated to pay first? The answer, frustratingly, is it depends entirely on the state you live in. This isn't a small detail. It is the single most important factor that dictates how your coverage works. Broadly speaking, states fall into two major categories. In the first category, the law makes the decision for you. In these states, your PIP coverage is always the primary payer for injuries sustained in a car accident. It doesn't matter if you have the best, platinum-level health insurance plan from your job. If you get hurt in a crash, your auto insurance company is first in line to pay. Your health insurance company gets to sit on the sidelines and wait. Let's say you have a $50,000 PIP policy and a health plan with a $2,000 deductible. You're in an accident and rack up $60,000 in medical bills. Your PIP provider pays the first $50,000. All of it. Only after that $50,000 is completely exhausted does the baton get passed. Your health insurance then looks at the remaining $10,000 bill. You'd pay your $2,000 deductible, and then your health plan would cover the final $8,000. Assuming that's how your coinsurance is structured. In this system, your PIP acts as a powerful shield, protecting you from your health insurance deductible and copays for that first massive chunk of expenses. But then there's the second category of states, and this is where things get really interesting and potentially very risky. These are often called choice or coordination of benefits states. In places like Michigan or New Jersey, the law gives you the power to choose. When you buy your auto insurance policy, you are asked to make a decision. Do you want your PIP to be the primary payer? Or do you want your health insurance to be the primary payer for auto accident injuries? On the surface, this sounds great. Who doesn't love having a choice? And the insurance companies make one option look incredibly tempting. If you agree to make your health insurance the primary payer, your auto insurance company will give you a significant discount on your PIP premium, sometimes saving you hundreds of dollars a year. Feels like a no-brainer. You already have health insurance, why pay twice? You take the discount, pocket the savings, and feel smart about it. But you may have just walked into a carefully laid trap. By choosing your health insurance as primary, you are fundamentally changing how everything works. You're telling your auto insurer, "You guys can be the backup. My health plan will handle it." You've just reassigned the first runner in the relay race. Now, when you get into that accident, you don't show your auto insurance card at the hospital. You show your health insurance card. And what's the first thing your health insurance requires? You have to meet your deductible. That $2,000, $5,000, or even $10,000 deductible that you normally only worry about for regular medical care is now the first bill you have to pay out of pocket for your car crash injuries. The savings on your car insurance premium can be wiped out by that one single expense. But it gets worse. Remember what PIP covers. It's not just medical bills. It covers lost wages, rehabilitation services, and in-home help. Your standard health insurance plan covers almost none of that. It's designed to pay doctors and hospitals, period. It won't give you a dime for the 2 months you're unable to work and have no income. It won't pay for a specialized van to take you to physical therapy. It won't pay for someone to help with cooking and cleaning while you recover. By making your health plan primary, you've put an insurance policy that is terrible at handling car accident consequences in the driver's seat. Your PIP policy might still cover those things as a secondary payer, but it becomes a much more complicated and drawn-out claims process. And now for the knockout punch. It's a legal concept called subrogation. It's a word that should send a shiver down your spine. Subrogation is the right of an insurance company to recoup the money they paid out for your claim from the person or party who was at fault. So, you chose your health insurance to be primary. They pay, let's say, $70,000 for your surgeries and hospital stay. A year later, you finally reach a settlement with the at-fault driver's insurance company for $100,000 to compensate you for your pain and suffering. Just as that money is about to hit your bank account, you get a letter. It's from a law firm representing your health insurance company. The letter says, "Pursuant to our planned subrogation clause, you are required to reimburse us the $70,000 we paid for your medical care out of your settlement." Just like that, 70% of your settlement money is gone. It doesn't go to you, it goes back to your health insurer. This happens all the time. Many employer-sponsored health plans, especially larger ones, have powerful subrogation rights, and they are relentless in pursuing them. Suddenly, that decision to save a few $100s on your car insurance premium has cost you tens of thousands of dollars from your settlement. You've essentially used your pain and suffering money to pay back medical bills that your PIP coverage would have paid for in the first place, with no right of subrogation. Let's make this real. Meet David, a 40-year-old graphic designer from a choice state. To save $60 a month, he designates his employer's health plan as his primary coverage. He has a high-deductible plan, but he's healthy, so he's not worried. One rainy afternoon, he's T-boned by someone who ran a red light. His leg is badly broken, requiring surgery and metal plates. The total medical bill is $45,000. First, the hospital demands his $6,000 health insurance deductible upfront before they'll schedule the follow-up surgery. He has to put it on a high-interest credit card. Second, he's out of work for 10 weeks. His health plan pays $0 for lost wages. His secondary PIP policy might, but it requires tons of paperwork, and the adjuster is slow to respond because they're not the primary payer. He's burning through his savings just to pay his mortgage. Third, after a long and stressful fight, he secures a $75,000 settlement from the other driver. Before he sees a penny, his health insurance company swoops in with a subrogation claim for the full $39,000 they paid after his deductible. After his lawyer's fees and paying back his health insurer, David is left with barely enough to cover his lost wages and pay off that credit card. The $720 he saved on his premium led to a catastrophic financial outcome. And we haven't even mentioned Medicare or Medicaid. If you're on one of these government plans, the rules are even more rigid. Federal law typically dictates that they are the payer of last resort. This means that any available PIP coverage must pay before Medicare or Medicaid will contribute a single dollar. So you are left with a critical, high-stakes decision in these choice states. Do you take the guaranteed, upfront savings on your premium? Or do you opt for the seamless, more comprehensive protection that comes with making PIP your primary payer? It's a trade-off between immediate savings and long-term security. One path is cheaper, but it's full of potential pitfalls, deductibles, coverage gaps, and the lurking threat of subrogation. The other path costs more, but it's a smoother, safer road if you ever have to travel it. Choosing the wrong one can be one of the most expensive financial mistakes a driver can ever make. So let's walk down that first path, the one that looks cheaper and more attractive up front. The first thing you'll see is a sign for a high deductible. A deductible is the oldest trick in the insurance playbook. It's the amount of money you agree to pay out of your own pocket for a claim before the insurance company pays a single dime. Think of it as your copay for a car crash. Your insurance agent might say, "Hey, if you take on a $1,000 PIP deductible, I can lower your premium by $20 a month." That sounds great, right? You're saving $240 a year. But what you're really doing is making a bet. You're betting $240 that you won't get into an accident. And if you win that bet, you're ahead. But if you lose big. Imagine you're in a minor accident. Someone rear-ends you at a stoplight. It doesn't seem too bad, but the next morning you wake up with a searing pain in your neck. You go to the emergency room. They do some x-rays, give you a neck brace, and prescribe some muscle relaxers. A few weeks later, the bill arrives. The ER visit, the diagnostics, the doctor's fee. It all adds up to $4,000. If you had that $1,000 deductible, you are now writing a check for $1,000. Your $240 savings for the year just got wiped out, and then some. You effectively paid the insurance company for the privilege of paying your own first grand in medical bills. That's the first pothole on the cheap road. It's a calculated risk, but one where the odds are stacked in the house's favor. But a deductible is a gap in coverage you can see. You know it's there. The truly terrifying risks are the coverage gaps you don't see until you've already fallen into them. This is where state minimums become so dangerous. Let's say you live in a state where the legally required minimum PIP coverage is $10,000. You buy a policy with exactly that amount because, hey, it's the cheapest way to be legal. You feel responsible. You're covered. But what does $10,000 actually buy you in the American healthcare system? An ambulance ride can be over $1,000. A single night in the hospital can be $5,000 or more before a doctor even sees you. Add in an MRI surgery for a broken bone, and a few physical therapy sessions, and that $10,000 is gone before you're even back on your feet. Everything after that? That's the gap. It's the vast, terrifying chasm between what your coverage paid and what your accident actually cost. And that money has to come from somewhere. Comes from your savings account. It comes from your kid's college fund. It comes from a second mortgage on your house, or worse, from bankruptcy. People lose their homes over this. They drain their retirement accounts. Their entire financial future is derailed because they chose the path that saved them maybe $30 or $40 a month. They didn't realize they weren't buying insurance. They were buying a lottery ticket with terrible odds. They were buying just enough coverage to be legal, but not nearly enough to be safe. That's the illusion of the cheap path. It feels like you're saving money, but you're actually sitting on a financial time bomb, just waiting for one bad driver or one patch of ice to light the fuse. Now let's talk about the most misunderstood and dangerous creature lurking in the shadows of this cheap path: subrogation. It sounds like a complicated legal term, and it is, but the concept is brutally simple. It's your insurance company's right to get its money back. See, in a no-fault system, your PIP carrier pays for your injuries first, asking no questions about who caused the accident. This is designed to get you medical care fast. But make no mistake, the insurance company has every intention of figuring out who is at fault later, because they don't like paying for things that weren't their client's fault. So let's go back to our rear-end collision. The other driver was clearly at fault. They were texting and didn't see you stop. Your PIP paid out, let's say, $15,000 for your medical bills and lost wages. Your insurance company isn't just going to say, "Oh well, that's the cost of doing business." No, they are going to turn around, point their finger at the at-fault driver's insurance company, and say, "You owe us $15,000. This process of one insurance company recovering money from another is subrogation. It's basically a legal battle between two giant corporations happening in your name about your accident. Why should you care? Because you are caught directly in the crossfire. If the at-fault driver has good insurance with high liability limits, the process might be smooth. Your insurer gets its money back and everyone moves on. But what if the at-fault driver only has the state minimum liability coverage of, say, $25,000? And what if your medical bills were actually $50,000? Your PIP only covered the first part, and now there's a massive shortfall. Or worse, what if the at-fault driver was uninsured or underinsured? Now your insurance company has nowhere to go to get its money back. They can try to sue the driver personally, but if that person has no assets, it's like trying to get blood from a stone. This is where the path you chose matters immensely. If you're on the cheap path with minimum coverage, you're left exposed. Your own insurance has paid its small limit and is now done with you. The at-fault driver has no money. You are left holding the bag for tens of thousands of dollars in remaining medical bills. However, if you were on the smarter path, the one with higher PIP limits and maybe even optional uninsured/underinsured motorist coverage, you have a safety net. Your own policy can continue to pay for your recovery, protecting you from the financial negligence of the other driver. Subrogation reveals the ultimate truth of insurance. Even in a no-fault state, fault always matters. And when the bills get high and the lawyers get involved, a cheap policy isn't a shield. It's a paper umbrella in a hurricane. Deductibles, coverage gaps, subrogation. These aren't just insurance terms. They are the mechanisms that can turn a car accident into a life-altering financial catastrophe. They are the toll booths on that cheap, easy road that end up costing far more than the price of a better policy. So you've chosen your deductible and your coverage limits. You think you've navigated the worst of it. But there's a fork in the road most people don't even know exists. It's the choice between coordinated and uncoordinated benefits. And picking the wrong one can mean your health insurance and your auto insurance go to war. With your life savings caught in the crossfire. It starts with a single, innocent-looking checkbox on your insurance application. A choice so deceptively simple it feels like it barely matters. But this choice is a fork in the road. One path leads to a streamlined, stress-free recovery. The other leads straight into a bureaucratic maze with you trapped in the center. This is the choice between primary and secondary payers, often labeled as uncoordinated versus coordinated benefits. Let's break down the jargon. Coordinated benefits sound good, right? It sounds efficient, organized. It implies your auto insurance and your health insurance are going to work together, holding hands and singing campfire songs. The reality is the exact opposite. When you choose coordinated benefits, you are officially telling your auto insurance company, "Hey, you're not the first line of defense. My health insurance is." This means after an accident, your health insurance pays first. Your PIP coverage only kicks in after your health insurance has paid its share. It becomes the secondary payer, there to clean up the leftovers, like deductibles and copays. The main reason people pick this? It makes your auto insurance premium cheaper. And that's the bait. On the other side, you have uncoordinated benefits. This sounds messy, disorganized, but it's the most powerful option you can have. By choosing uncoordinated, you are designating your PIP coverage as the primary payer for your medical bills. Your auto insurer is on the hook to pay first, up to your policy limit. Your health insurance only gets involved if the costs exceed your PIP coverage. This option makes your auto insurance premium a little bit higher. And that's what scares people away. To see why paying a little more is one of the smartest financial decisions you can ever make, let's imagine a scenario. Meet two drivers, Sarah and Mike. They live in the same town, have similar jobs, and get into identical accidents on the same day. Both are T-boned by someone who ran a red light. Both suffer a broken leg and a concussion, leading to an emergency room visit, surgery, a hospital stay, and months of physical therapy. The total medical bill for each of them comes to $100,000. The only difference? Sarah chose coordinated benefits to save about $80 a year on her car insurance. Mike chose uncoordinated benefits, paying that little bit extra. Let's follow Sarah first. She's wheeled into the emergency room. The hospital billing department gets her information. She hands over her health insurance card because remember, her health plan is primary. The first problem hits immediately. The hospital submits the claim, and her health insurance company sees the diagnosis code, motor vehicle accident. For them, this is a giant red flag. Their internal logic says, wait a minute, a car crash? There's auto insurance for that. Why should we be the ones to pay? So the battle begins. Her health insurer might delay the payment, asking for more documentation. They might demand a copy of the police report. They might want a statement from the auto insurer. While they're dragging their feet, Sarah gets her first bill in the mail. Her health insurance has a $5,000 annual deductible. So before her insurance company pays a single penny, Sarah has to cough up $5,000 out of her own pocket. She's in pain, she can't work, and now she has to drain her savings account. But it gets worse. After she meets the deductible, her plan has a 20% coinsurance. That means she's responsible for 20% of the remaining $95,000. That's another $19,000. Suddenly, that $80 she saved on her premium seems like a cruel joke. Her PIP coverage is supposed to be secondary, covering these out-of-pocket costs. But to get that money, she can't just send the bills to her auto insurer. No, she has to pay the hospital first or let the bills pile up, and then submit a mountain of paperwork, the explanation of benefits from her health insurer, the itemized bills from the hospital, to her auto insurer for reimbursement. It's a second full-time job she has to do while recovering from a serious injury. Meanwhile, the two insurance companies are pointing fingers at each other. The health insurer says the auto insurer should pay more. The auto insurer says they're only the secondary payer, as per Sarah's choice. And while they fight it out, Sarah is the one getting calls from collection agencies. Her credit score is now on the line. And what about her care? The top orthopedic surgeon in her city, the one everyone recommends? He's not in her health insurance network. If she wants the best care, she has to pay even more out of pocket. She's forced to choose a doctor based on what her restrictive health plan will cover, not who is the best person to fix her leg. Sarah is trapped. She saved $80 and in return, she got a $5,000 deductible, $19,000 in coinsurance, endless stress, a blizzard of paperwork, and potentially compromised medical care. This is the reality of coordinated benefits. Now let's look at Mike. He chose uncoordinated benefits. He paid that extra $80 a year. He's wheeled into the same emergency room. The billing department asks for his insurance. He doesn't give them his health insurance card. He gives them his auto insurance card. He says, "My PIP is primary." For the hospital, this is like a magic key. They submit the bill directly to Mike's auto insurance company, and the check arrives fast. There is no deductible for Mike to pay. There are no copays. There's no 20% coinsurance. His auto insurer pays the first $100,000 of his medical bills directly, cleanly, and without question. Mike needs to see that top orthopedic surgeon who is out of network for Sarah? No problem. PIP coverage doesn't have networks. Mike can go to any licensed doctor, specialist, or therapist he chooses. He gets the absolute best care possible, period. While Sarah is on the phone for hours, arguing with 2 different insurance companies, Mike is focusing on his physical therapy. While Sarah is watching her savings drain away, Mike hasn't paid a single dollar out of pocket for his medical treatment. While Sarah is getting threatening letters from collection agencies, Mike's bills are being handled seamlessly behind the scenes. His $100,000 in medical bills are completely covered by his primary PIP. His health insurance is never even contacted. The war between insurers never happens because there's only one company at the front line, and it's the one designed specifically for this situation. His auto insurer. The difference is night and day. The term coordinated is one of the most misleading words in the entire insurance industry. It sells you a picture of harmony, but delivers a reality of conflict, leaving you to pay the price. Uncoordinated sounds chaotic, but it provides a single streamlined path to getting your bills paid and your health restored. This isn't just about money, it's about your peace of mind. The stress of fighting with insurance companies can physically impede your recovery. The financial strain can devastate your family. Choosing coordinated benefits to save a few bucks is like removing the airbags from your car to save on weight. It seems like a clever optimization until the moment you actually need them. So why do they even offer this choice? Because it benefits the auto insurance company. By getting you to designate your health insurance as primary, they successfully shift billions of dollars in liability from their books onto the health insurance industry's books. They can offer you a lower premium because they've massively reduced their own risk. They've made it your problem, not theirs. They're betting that you'll be tempted by the short-term savings, without ever understanding the catastrophic long-term risk. Understanding this one single choice, coordinated versus uncoordinated, is more important than comparing quotes or looking for discounts. This choice determines what happens in the moments after a crash, and it can define the next year of your life. It's the difference between being a victim of your circumstances and being the master of your recovery. It's the insider knowledge that separates the savvy driver from the one who's about to walk, completely unprepared, into a financial ambush. So let's walk you straight through that ambush and give you the map to get out the other side. The moment of impact isn't just about the physical collision. It's the start of a timer. A clock begins ticking, and the moves you make in the first 24 to 48 hours can determine the outcome of your entire claim. This is your playbook. The very first thing you do, after ensuring everyone is safe and calling 911, is understand that the police report is not just a formality. It is the foundation of your entire story. It's the first official third-party account of what happened. Without it, you're immediately in a he said, she said situation, and insurance companies love that ambiguity because it gives them leverage to deny. Get the officer's name, their badge number, and the report number. This document is your first piece of armor. Step 2, and this is arguably the most critical mistake people make. You must seek medical attention immediately, even if you feel fine. Adrenaline is a powerful anesthetic. It can mask serious injuries for hours, even days. You might feel a little stiff, a little sore, and think, I'll just walk it off. This is a catastrophic error. In the world of insurance, there's a concept called a gap in treatment. If you get in an accident on Monday, but don't see a doctor until Friday, the insurance adjuster will pounce on that gap. They will argue, well, if the injury was really from the accident, why did you wait 4 days? Maybe you slipped in the shower on Wednesday. Maybe you hurt yourself at the gym on Thursday. We can't be sure the accident caused this injury. And just like that, the legitimacy of your claim is undermined. Go to an urgent care clinic, the emergency room, or your primary care physician the same day if possible. Create a documented, time-stamped medical record that links your injuries directly to the accident. This closes the gap and shuts down one of the adjuster's favorite tactics before it even begins. Now, you have to notify your own insurance company. This is your PIP claim, remember? It's with your insurer, regardless of who was at fault. When you make that call, you enter a new phase of the game. The person on the other end of the line, the adjuster, may sound friendly. They may sound compassionate, but you have to understand their job. Their primary function is to protect the insurance company's bottom line. That means paying out as little as legally possible on every claim. They are not your friend. They are a professional negotiator for the opposing side. So when you speak to them, stick to the facts. The bare, verifiable facts. There was an accident on this date at this time at this location. A police report was filed. Number 12345. I have sought medical treatment for my injuries. That's it. Do not speculate. Do not say, I think the other driver was texting. Do not apologize or say anything that could be twisted into an admission of fault. And for the love of everything, do not, under any circumstances, utter the 6 deadliest words in any insurance claim. I'm okay, or I feel fine. You are not a doctor. You don't know the extent of your injuries. That simple, polite phrase can be recorded and used against you later to argue that your injuries must not be that serious. From this moment forward, you become a meticulous record keeper. You are building a fortress of evidence brick by brick. Get a dedicated folder or a box. This is your claim Bible. Every single piece of paper related to this accident goes in it. Every doctor's bill, every receipt for a prescription, every explanation of benefits from your health insurer. Keep a log of your mileage to and from every single medical appointment. That's a reimbursable expense under many PIP policies. If you have to buy a neck brace, a crutch, even a bottle of Tylenol, keep the receipt. And the biggest piece of this puzzle? Lost wages. PIP is designed to replace a portion of your income if your injuries prevent you from working. But they won't just take your word for it. You need to prove it. Get a letter from your doctor explicitly stating that you are unable to work due to your injuries, and for how long. Get copies of your pay stubs from before the accident to establish your average income. You have to hand them an undeniable mathematical calculation of what you have lost. If you give them vague information, they will give you a vague and very small settlement. Now, somewhere in this process, you might get a letter requesting you attend something called an independent medical examination, or IME. The name itself sounds fair, impartial. It is one of the most misleading terms in the entire insurance industry. An IME is an examination by a doctor who is chosen and paid for by your insurance company. Let me repeat that. The doctor works for them, not for you. Their goal is not to treat you. Their goal is to evaluate your condition and write a report for the insurance company, often with the specific aim of finding a reason to terminate your benefits. They might determine your injuries have resolved, or that the treatment you're receiving is no longer necessary, or the classic move, that your condition is pre-existing and wasn't caused by the accident at all. You are required to attend this appointment. Skipping it can result in an automatic denial of your benefits. But you go in prepared. You go in knowing who you are talking to. Be polite, be honest about your symptoms, but do not exaggerate. Do not downplay your pain either. The doctor will be observing you from the moment you walk into the waiting room. They will note if you're scrolling on your phone, how you sit down, how you stand up, how you walk down the hall. They are looking for any inconsistency between what you say and what you do. This is the insurance company's secret weapon, and by knowing what it is, you've just disarmed it. Finally, let's untangle the web of who pays for what. You have your PIP coverage, and you probably have health insurance. How do they work together? This is called coordination of benefits, and it can be a nightmare if you don't understand it. In most no-fault states, PIP is primary. This means your auto insurance is the first in line to pay for your medical bills, up to your policy limit. You submit all your bills to your auto insurer first. Once your PIP benefits are exhausted, once you've hit your $10,000, $20,000, or $50,000 limit, your health insurance then becomes the primary payer. It kicks in as the secondary layer of protection. Getting this order wrong can be a disaster. If you send your bills to your health insurance first, they'll likely deny the claim, stating that auto insurance should be primary. This creates delays, confusion, and can even result in your bills being sent to collections while the two insurance companies point fingers at each other. Always clarify the order of operations. Call both your auto insurer and your health insurer and ask them directly. For an auto accident injury, who is the primary payer? Get the answer, document who you spoke to and when, and follow that protocol exactly. You've now navigated the immediate aftermath. You've built your fortress of evidence. You've stared down their independent doctor. And you've directed the flow of bills like an air traffic controller. You've done everything right. You've played the game perfectly by their rules. But then one day you check the mail. And there it is. A crisp, formal envelope. Inside is a letter, full of dense legal jargon. But the message is brutally simple. Your claim has been partially or fully denied. The ambush you tried so hard to avoid has just been sprung. All your preparation, all your documentation, and they still said no. What do you do now? Because this is where the polite requests end, and the real fight begins. The first thing you do is take a deep breath. Panic is the enemy. It's what they expect. It clouds your judgment and makes you reactive. You are not going to be reactive. You are going to be strategic. You are going to be methodical. You are going to treat this denial not as a defeat, but as the first move in a chess match they just started. And your first countermove is to become an expert on their attack. You need to get that denial letter in your hands and read it like it's a treasure map. Buried in the dense, formal language is the exact reason they said no. And that reason is your target. Don't just skim it. Dissect it. Insurance companies don't just write no on a piece of paper. They are legally required to provide a specific reason for the denial. Is it because they believe the treatment wasn't medically necessary? Is it because you missed a filing deadline? Did they say your injuries weren't related to the accident? Or did they use the results of that independent medical examination, the one with their doctor, to claim you've recovered even though you're still in pain? Each of these reasons is a different line of attack, and each requires a different defense. You cannot fight back effectively until you know exactly where they are aiming. Highlight the specific clause, the specific policy language, the specific medical opinion they are using as their shield. This denial letter is no longer just bad news. It's intelligence. It's the blueprint of their argument, and you're going to use it to build your own. Once you understand their reason, your next step is the formal internal appeal. This isn't just sending a frustrated email or making an angry phone call. An internal appeal is a formal written request for the insurance company to reconsider its decision. This is a critical step that many people skip, but it's your first official move on the board, and it puts the ball squarely back in their court. Your appeal letter needs to be a masterpiece of precision and evidence. It must be professional, unemotional, and overwhelmingly factual. Start by clearly stating that you are appealing the denial of your claim, referencing the claim number, the date of the denial letter, and your policy number. Then address their specific reason for denial head-on. Don't just say you're wrong. Prove it. If they said a treatment wasn't medically necessary, you counter with a detailed letter from your own doctor. This letter shouldn't just be a prescription note. It needs to be a narrative. It should explain in clear terms why the treatment is essential for your recovery, how it directly relates to the injuries from the accident, and what the consequences would be without it. Attach the medical records, the test results, the physical therapy notes, every piece of paper that supports your doctor's professional opinion. You are building a mountain of evidence so high that their single, isolated reason for denial looks like a pebble at the bottom. If they denied you based on a missed deadline, you need to prove why. Was the form lost in the mail? Did the hospital delay sending the records? Provide any proof you have: postal receipts, communication logs, a letter from the hospital's billing department. Show that the delay was reasonable and not your fault. If they are using their IME doctor's report against you, you fight fire with fire. You get a counter report. You go back to your treating physician and have them write a direct rebuttal to the IME report, pointing out inconsistencies or disagreeing with the conclusions based on their long-term observation of your condition. Remember, their doctor saw you for maybe 15 minutes. Your doctor has been with you through the entire process. Whose opinion should carry more weight? You make that argument on paper with supporting documentation. Your appeal letter is not a plea for mercy. It is a structured legal argument. You are creating a paper trail. You are demonstrating that you are organized, serious, and prepared. Send this appeal via certified mail with the return receipt requested. This is non-negotiable. You need absolute proof that they received it and when. This single action prevents them from ever claiming, "We never got your appeal." Now, while you wait for their response to your appeal, and they do have a deadline to respond which varies by state, you don't just sit by the phone. You escalate. Most people have no idea this next step even exists, but it is one of the most powerful tools you have. You file a formal complaint with your state's Department of Insurance. Think of the Department of Insurance, or DOI, as the referee. Their job is to make sure insurance companies play by the rules. They are a government agency with regulatory power. Filing a complaint is usually free and can often be done online. You will provide them with all the information: your policy details, the claim number, a copy of the denial letter, and a copy of the meticulously crafted appeal you just sent. When the DOI opens an investigation, the insurance company is now forced to answer to a regulator, not just to you. They have to justify their denial to a government body that has the power to fine them or even sanction their license. This changes the dynamic completely. Suddenly, your claim is not just one of thousands they are processing. It's a problem case that has attracted official oversight. It gets a red flag. It gets escalated to a senior adjuster or an internal legal team. Sometimes, the mere act of filing a DOI complaint is enough to get a denial overturned, because the insurer decides it's simply not worth the regulatory headache and scrutiny. But what if even that doesn't work? What if your appeal is denied, and the DOI investigation sides with the insurer or stalls? You've followed the process, you've presented your evidence, and you've hit a brick wall. This is the point where many people give up. This is the point where you do not. This is the point where you bring in the heavy artillery. This is when you call a lawyer. And I know what you're thinking. I can't afford a lawyer. Here is the most important thing you need to understand about this process. Most reputable personal injury attorneys work on what's called a contingency fee basis. This means they do not charge you a single dollar up front. They get paid a percentage of the money they recover for you. If they don't win your case, you owe them nothing for their time and effort. This aligns their interests perfectly with yours. They only take your case if they believe they can win, and they are highly motivated to get you the maximum settlement possible. Finding the right lawyer is key. You don't want a general practice attorney. You want a specialist. A lawyer who lives and breathes auto accidents and PIP claims in your state. They know the adjusters, they know the opposing counsel, they know the judges, and most importantly, they know the insurance company's playbook inside and out. They know every trick, every delay tactic, and every weak point. When you hand your case over to an experienced attorney, the entire game changes. The letters are now on law firm letterhead. The phone calls are with their legal department. The threat of a lawsuit is no longer a distant possibility. It's a very real and immediate probability. The insurance company's cost-benefit analysis shifts dramatically. The cost of fighting an experienced law firm is far higher than fighting you alone. Suddenly, settling your claim for the full amount you're owed might start to look like a very good business decision for them. And in some cases, your lawyer might find that the insurance company didn't just make a mistake. They may have acted in bad faith. Bad faith is a legal term for when an insurer denies a claim without a reasonable basis, or when they fail to conduct a proper investigation, or intentionally delay payment for no good reason. It's not just about being wrong. It's about being intentionally unfair and unreasonable. If your lawyer can prove bad faith, you may be able to sue not just for the original benefits you were owed, but for additional damages as punishment for their conduct. This is the ultimate checkmate. You've now gone from a victim of a denial to the commander of a multi-front campaign. You have a detailed internal appeal, an active complaint with the state regulator, and a legal expert ready to file a lawsuit. You have systematically dismantled their reasons for denial and replaced them with an ironclad case for payment. You have taken control. You have shown them that you will not be ignored, and you will not back down. You've launched your counterattack, and you are prepared for total war. But what does winning actually look like? And more importantly, how do you make absolutely sure you are never, ever in this vulnerable position again? That is the final crucial piece of this entire puzzle. Winning, in this context, isn't about a courtroom victory with a gavel slam. It's quieter but far more profound. Winning is getting a check that covers every single dollar of your medical bills, from the ambulance ride to the final physical therapy session. Winning is receiving your lost wages, not 80%, not 60%, but the full amount you're entitled to, allowing you to pay your mortgage and keep the lights on without draining your life savings. Winning is having the essential services you need, like help with childcare or housekeeping because you can't lift a laundry basket, paid for without a fight. Ultimately, winning is closing this chapter of your life with your health, your finances, and your sanity intact. It's about making the insurance company fulfill the promise they made when they took your first premium payment. But here's the most important truth of all. The best way to win the fight is to build a fortress so strong that the fight never even begins. You want to make your claim so undeniable, your coverage so robust, that the insurance company looks at your file and realizes that trying to deny or lowball you would be a colossal waste of their time and money. You want them to pay it, and pay it fast, because it's the path of least resistance. So how do you build this fortress? How do you ensure you are never in this vulnerable position again? It comes down to a handful of non-negotiable actions you need to take, not after an accident but right now. Think of this as your financial prepper's guide to surviving a car crash. First, and I mean do this the second this video is over, pull up your auto insurance policy. Find the declarations page. It's the summary of your coverage. Look for the line that says Personal Injury Protection, or PIP. What is the number next to it? Is it 10,000? 15? 50? You need to know this number like you know your own address. This number is the absolute ceiling on what your insurer will pay for your injuries, period. Then look for your deductible. How much do you have to pay out of pocket before PIP even kicks in? Is it $250? $1,000? $2,000? Choosing a high deductible to save a few bucks a month can be a catastrophic mistake when you're suddenly injured and out of work. You need to know these two numbers cold. Not knowing them is like flying a plane without knowing how much fuel you have on board. Second, you must understand the battlefield. Is PIP mandatory in your state? Is it optional? Or is it not available at all? If it's mandatory, what is the minimum limit required by law? This is critical because insurance agents will often sell you only the bare minimum to give you the cheapest quote. But the state minimum is not a recommendation. It's the lowest legal level of protection, and it is almost never enough. A single night in a hospital, an MRI, and a few follow-up appointments can obliterate a $15,000 PIP policy before you've even gotten your first physical therapy bill. The minimum is a trap, designed to make you feel protected while leaving you dangerously exposed. This brings us to the third and most powerful action you can take. Raise your limits. I cannot overstate this. The difference in premium between a rock-bottom $15,000 PIP policy and a much safer $100,000 or even $250,000 policy is often shockingly small. We're talking about the cost of a few lattes a month. Let's make this real. Imagine you're in a serious accident. The ambulance ride is $2,500. The emergency room visit with a CT scan is $8,000. You've just burned through $10,500 of a $15,000 policy in the first 6 hours. You still need surgery on your broken leg, which will be another $20,000. You're already deep in the red, and you haven't even considered the weeks of lost wages or the months of physical therapy you'll need to learn to walk again. All of that extra cost now comes directly out of your pocket. Your savings, your kids' college fund, your retirement, it's all on the line because you tried to save $12 a month. Call your agent and ask for a quote to increase your PIP limits. Ask for several options. You will be stunned at how affordable real protection actually is. Fourth, you need to understand two slightly more advanced, but life-saving concepts: coordination of benefits and stacking. In many PIP states, you can choose how your PIP interacts with your regular health insurance. This is called coordination of benefits. You can designate either your health insurance or your auto insurance as the primary payer. If you have a fantastic health insurance plan with a low deductible, it might make sense to list it as primary, which can lower your auto insurance premium. But if your health plan has a sky-high deductible, making PIP primary is your shield. It pays first, covering your immediate bills and satisfying that big health insurance deductible for you. Getting this choice wrong can cost you thousands. You need to review your health plan and your auto policy side by side and make a deliberate, informed choice. Stacking is another superpower. If you have multiple cars on your auto policy, some states allow you to stack your PIP coverage. Let's say you have $25,000 in PIP coverage and 3 cars on your policy. Stacking allows you to multiply that coverage by the number of cars, giving you a total of $75,000 in available benefits. It's a game changer. It costs a little more, but it's one of the most efficient ways to dramatically increase your protection. Ask your agent directly. Is stacking available for PIP in my state, and am I signed up for it? Fifth, and this is the final layer of your fortress, you must have high limits on your uninsured and underinsured motorist coverage, or UM/YUM. Remember, PIP is no fault. It pays for your injuries regardless of who caused the crash. but it typically doesn't cover pain and suffering. If the other driver was at fault and they have little or no insurance, your UM/UIM coverage is what steps in to pay for your medical bills that exceed your PIP limits, your future lost income, and the immense personal cost of your pain and suffering. Having great PIP but no UM/UIM is like having a bulletproof vest but no helmet. It protects your core but leaves you critically vulnerable. These two coverages work together as a complete system to protect you from both yourself and the millions of irresponsible drivers on the road. Finally, prepare for the worst right now while everything is calm. Create a crash kit in your glove box. It should have a pen, a notepad to get witness information, a disposable camera if your phone is broken, and most importantly, a copy of your insurance declarations page. You shouldn't be fumbling through an app trying to find your policy number while you're in shock on the side of the road. Create a folder in the cloud or on your computer labeled, "In case of emergency." Inside, have a PDF of your full auto policy, your health insurance card, the name and number of your insurance agent, and even the contact information for a highly rated personal injury attorney you've researched in advance. Being prepared isn't paranoid. It's a strategic advantage. It ensures that if the worst happens, you're not starting from zero. You're starting from a position of power, with all your critical information organized and ready to deploy. What we've talked about in this series isn't just about insurance. It's about taking control. It's about understanding that the piece of paper you get from your insurance company isn't just a legal requirement. It's a financial life support system. And it's up to you to make sure it's strong enough to do its job when you need it most. You now understand what PIP is, how it works, how insurers try to fight it, and most importantly, how to build a policy so strong it makes you a hard target. You are no longer in the dark. The power has been transferred from them to you. Use it. Check your policy, call your agent, and build your fortress today.